Hello, this is John from OptionsMeister.com. And my video today is on the secret to my 70% win rate in option trading, and it's just all about the math. We're going to dig deep into standard deviation, which is the math behind 68% win rates. Let's get started. Everyone wants to know my secret to 70% win rates. People think I have some kind of magical system, some insider information, or some crystal ball that tells me exactly what's going to happen next. But there is no secret. It's just the math. One standard deviation gives you a 68% probability of success, and I'm going to show you exactly how this works using nothing but the option chain. No charts, no indicators, just the basic statistics that anyone can understand. Look, I get it. Someone tells you they've got 70% win rates and you're not real familiar with options trading, your BS detector should go off. Mine would probably too. So let me show you the math behind the method. First thing you need to understand is this isn't 70% of my money. This is 70% of my trades have a positive result. I might make $200 on one trade. I might lose $400 on another trade, but over time, the math still works out probabilistically and profitably because of positive expectancy. Let's start with the basics. Standard deviation is just a fancy way of measuring what is the expected price range in a specific amount of time. Think of it like this. You throw a bunch of darts at a dartboard. Most of them are going to cluster around the center, but some are going to go wide. Stock prices work the same way. Most of the time they stay relatively close to the range that is expected, but sometimes they move a lot, but that's a lot less common. The beautiful thing is this follows a predictive pattern, what statisticians call a bell curve or a normal distribution curve. Here's a screenshot of a normal distribution curve, and we're going to mostly be focusing today on that middle section. It says 68.3% of data. That's where we live most of the time. But you can try to put that image in your mind, so as we talk about this going on, you'll have a clear understanding of what's going on. We do some trades in that second standard deviation area, which is 95%, or even the third, which is 99.7, but we're going to be mostly talking about the 68.3% range today. Now here's a key insight. If I sell options outside of that range that you just saw on the previous slide, I've got a 68% chance of winning. The market literally is telling me those are the probabilities. And it's just the math. There's a fancy formula that we don't have to concern ourselves with called Black-Scholes. There's a couple other ones that the options companies use, but all we have to worry about is it's right there on the chain. We use a simple formula, but the more detailed formula is right on the option chain, and I'll show you that right how those numbers equate to 68% right on the option chain. Here's the option chain, and here's the beautiful part. You don't need any fancy software or complicated calculations. The option chain tells you everything you need to know. So we're going to start. I'm going to put the little laser on here as it pointed out to you. Up here in the upper right-hand corner, that little green box, it says 15.3%, and then plus or minus 15.02, if you can read that. Well, the 15.3% is the implied volatility for this 18-day period that we're in. This trade was done on September the 2nd, and there's 18 days to expiration. So the next area, the implied vol, or the red price box is right here, is 645. That's the price of SPY at the time of this trade, and you can see it up here. Last price 645. So the expected range then is plus or minus $15, as we talked about up here. So the total range is $30. You're going to be plus 15 and minus 15. So that gets us from 630 to 660. And that should be pretty easy to understand, I hope. Now what that trade is that I just explained to you is I'm selling a strangle. And so I'm selling a put. In this case, I'm selling a put at the 630 strike, and I'm selling a call at the 660 strike. And I've got a 68% chance that both options will expire worthless. In other words, for the next 18 days, the period of this trade, price will stay inside of that, and every day those options that I sold will lose value. Let me show you how this works with a real example, just like we looked at on the chain. The price is currently 645. The implied volatility number is at 15.3% up in the little green box. the market's expectation of how much the stock will move is plus or minus 15.02. So we're going to use $15. And from that on, from that point, you can calculate that the one standard deviation is 630 to 660. Pretty simple. And that's really all we have to concern about. And as you can see, it's right there in the option chain. So if supply is 645 and the implied volatility is 15%, we got roughly a plus or minus $15 move in either direction, total range of $30. So that's the one standard deviation range. In this particular example, I collected $344 for the short put. I collected $143 for the short call for a total premium collected of $487 for each one lot trade that I put on. Now, what I typically do is set a good to cancel order to buy that trade back for 50% of what I sold it for. As I sold it for $487, I'll try to buy the trade back for 50% or around $243. So in this example, there's approximately a 70% probability, again, I'm beating your head against the wall with that number, that the price of the SPY stays between 630 and 660. The mechanical exit is a 50% of the premium collected, so in this case, $244 debit we'll put up there, and if we get filled, we'll make $243. Now, if we add in proper trade management on the 32% trades that don't really work out, get outside that 68% range, that's how we help get above the 70% win rate. I want to be clear about something right now. This doesn't mean I win 68% of the trades, lose 32% of the trades. That might have inferred that by what we've gone through so far, but the markets are very efficient, but they're not perfectly efficient. Sometimes I'll win 80% for a couple of months, sometimes I'll win 60%, but over a period of time, the math works. This is much the same as the casino analogy, and exactly how casinos work. We know they don't build those big, beautiful buildings on losing money all the time. They know what their odds are every single hand that they do, every single type of gambling that they have in the facility, and they know, and this is exactly how they work. They don't know which individuals, when you sit down at blackjack, whether you're going to win or lose. They just know that over thousands of hands, the math works in their favors. They have a slight edge, so enough occurrences, enough to, like we do trades, they're doing enough hands of blackjack, they know, hey, I might lose on this one, but over a long period of time, the odds are in our favor, and we're going to have a net positive expectancy. Insurance companies do the same thing. They don't know which specific client's going to have a claim on a particular day or month, but they know that over millions of policies, the math works in their favor. As a premium seller, that's what I'm doing. I'm the casino or I'm the insurance company. I don't need to predict individual outcomes. I just need the math to work over a large number of trades. Bottom line. But over a large number of trades, and I'm talking hundreds of trades over years, the math works. It's just like flipping coins. You flip 5 coins, you might get 5 heads. Heck, you might get 5 tails. I think we all realize that that's a possibility. Probably not likely, but it's a possibility. But if you flip 1,000 coins, you're going to get close to 500 heads and 500 tails. See, most traders try to predict direction. 95% of traders are long, and they want to buy low, sell high. They're long. The world's long because that's the only thing they know. They look at charts, they read news, they analyze fundamentals, but picking the direction of a stock or an ETF is 50-50 at best. But in this case, I'm not predicting direction. I'm betting on what won't happen, where the stock won't go. I'm betting that SPY won't move more than one standard deviation and the price stays between 630 and 660. The math tells me I'll be right 68% of the time. Now here's another key point. This also works because of time decay. In the options world, they call it theta decay, because when you buy something with a determined amount of time left, like in this case 18 days, if you buy that option, it loses value every day. Conversely, if you sell the option like we do, it loses value every day. So every day that passes, the options lose value, and that's just, we're picking up a little bit of our profit day after day after day. So even if the stock moves against me directionally a little bit, time's working in my favor. It's like I'm selling an insurance policy each month. If there are no claims that month, I keep that premium and I do the same thing next month. Now, what about the 32% of trades that don't work out perfectly? This is where experience and proper management come in. Sometimes I can adjust the position. Sometimes I take a small loss early and redeploy the capital. That's rare, but I do that. And then sometimes I'll take a potential big loss when a stock just really blows through either one of those strikes, either the call side or the put side. It'll take me some time to manage it, but I can typically manage those back to a small win or break even through proper management. This is the part that separates successful option traders from unsuccessful ones. Anyone can sell options. I always say any monkey can put on a trade. That's the easy part. I can send you trades out, you can put them on, and most of the time you don't have to deal with them, but it's those ones that get in trouble that you need help on how to manage them properly and not just puke them out as soon as they go against you, which is what most traders have a tendency to do. As soon as it moves a little bit against them, they're out of there and they take the loss. We don't do that at OptionsMeister. The key is thinking long term. I'm not trying to hit home runs. I'm not trying to get rich quick. I'm just trying to let the math work over a long period of time. And think of it like owning rental property if you've ever been a landlord. Some months you might have repairs or you might even have vacancies. But over the years, the rental income and appreciation work in your favor. It's the same principle here. So there you have it, the math behind 70% win rates. It's not magic. It's not a secret system. It's just basic statistics over a long period of time. And really, it's pretty simple. It's a lot easier than trying to pick direction on a stock and being better than 50%. Again, refresh your memory, here is a standard deviation or long normal distribution curve. We're working in that 68.3% range. So one standard deviation has a 68% probability that price is going to stay in there. So let me turn that. So what I'm saying is, if we sell a put out here and we sell a call over here, we know that we've got a 68% chance that price is going to stay within this range, and these are going to lose value every single day, or even if we wait till expiration, which that's not part of what we do at OptionsMeister, but they will expire worthless. Now, if you want to see this math in action, I apply these calculations to every single trade that I make. We talk about it in the private chat with the live trades in real time. My members see the probabilities, the reasoning, and the results in real time, and they ask me questions if they have questions or concerns about a particular trade. But over the period of time, the math works. That's the important thing. Now, if you have any trades that you have some issues with, or you want some information on, drop me a comment. And when you show me the calculation, I'll show you the probabilities on the stock you're watching. I'll break down the probabilities for you. Here's a little information on the gold membership. We've got it's kind of self-explanatory there. You can read it. We have I send out real trades, and I send all my trades out in real time, any adjustments and exits, and you can earn while you learn, is what we say. I keep it a very small group, and we all get to be friends in there, and it's you can, like I said, you can earn while you learn. Here's my contact information. You can reach me by email, john@optionsmeister.com. My MS Teams ID is john_FLA, and my mobile phone's 513-518-6666. Or check out any of the websites, optionsmeister.com. I have a free membership. It's called the Bronze Level. If you visit there, you can join that. You'll have access to some more trading resources. I've got another website, johnandrus.com, which is mostly an internet site, but you can happy to check that out. I've got a Facebook group and the YouTube channel. You can check out the YouTube channel at youtube.com at OptionsMeister1. If you go to the website, you'll see a video there on the gold level membership, and I have some courses in Thinkific, but I'm actually in the process of moving all over to go high level right now, so this slide will be changing. But if you have any questions on any of my courses, or you want to take a look at them, just let me know. I'll get that link to you. I have my primary book is Introduction to Probability-Based Trading, which I published about 4 years ago, and I'm just redid it and updated it, and it's going to be available in digital format.